what happens when you do these podcasts and you try too hard to make it perfect, it starts to get stiff. And that's been happening all night. I've been working on this for the last couple of hours, and I've been trying so hard to get it right that it just kept getting worse and worse and worse. So this is the last time I'm going to try it. It is getting late at night here, and if I don't get it this time, then we're going to cut it for the evening. So let's give it a shot. Welcome to the Money Runner. I see I did it again. Welcome to the Money Runner. I'm David Nelson, your host. We had such a great response from our show last week and the format that we used. We're going to try it again. It's going to be a little bit more conversational, a little bit less scripted, no teleprompter. Going to open up my brain, kind of give you my sense of thinking here. I'm really just looking at my screen and some charts, and I'm going to kind of walk you through that. Like last week, I'm going to walk you through a conversation that I had with our advisors who are based around the country here at Bell Point earlier this afternoon. And of course, today is Thursday, the day after an important Fed decision day where the Fed cut 50 basis points. Why is that important? Well, typically, the Fed has the street has a pretty good idea about what's coming from the Federal Reserve. The Fed doesn't like surprises. Certainly Jay Powell doesn't like that. He does a very good job of telegraphing the message well in advance. But this time around, it was a little different. Now, Bloomberg did some research on this and posted an article yesterday. I just happened to come across it early this morning, and this may be the answer. Apparently, if the Fed had not cut 50 basis points at this meeting, it would have been the biggest miss since the bankruptcy of Lehman back in 2008 during the financial crisis. And what I mean by that is a miss in perception. The market prices in one thing and the Fed delivers something else. But nevertheless, we got the 50 basis points. And of course, today, the markets took off. The S&P 500 opened and stayed at an all-time high. I saw the Dow cross 42,000 for the first time. I think the S&P was up 1.7%. The NASDAQ up 2.5%. So all in, a pretty good day. We're going to dig down into some of the details because in the end, what this is all about is what's working, what isn't, and what's next. Let's get started. If we're going to dig down into the charts, then we have to start with the S&P 500. Why? Because that's where the market cap is. Some of the largest companies on the planet are, of course, leaders in this index. And as you can see on the chart on your screen, you can see that we did break to that all-time high, and we are actually breaking back into the channel that was established all the way back in October last year. And that was really the first time that we had a sense that the Fed was going to embark on a cutting cycle. Now, we didn't get confirmation of that until Jackson Hole this year back in August. And of course, here we are today. We've made the first cut. So what does that mean going forward? How many more times are they going to cut? And what asset classes and what market caps and what secular themes can we play to maybe get an edge on this market? So what I like to do is start off by digging down deep into something like the sector performance, try to get some information there. And what you can see on your screen there, that's sector performance year to date. A couple of things to notice. First, the good news is that all the sectors are positive year to date. What's different this time around is that utilities are in the lead. Now, I've been doing this a while. Most bull markets are not led by utilities. As a matter of fact, I'm trying to think of a period of time in my career, which started in the early 90s when utilities were the leading sector in a bull market. I may have to go back, but I can't think of one offhand. But this time around, there may be a reason for it. Now, I think you can look at utilities now as really a risk-on and risk-off trade. It's a way of playing offense and defense at the same time. Now, we know it's defensive in the sense that it pays that dividend, certainly a steady stream of income because, why? It's a utility, all right? We got to have it. But it's also offensive in the following sense, that it's a backdoor way to invest in AI. The one thing we know about artificial intelligence is that we're going to need power and lots of it. What I like about this trade right now is that the utility sector is about 2% of the S&P 500 today. I could see it easily growing to double that at some point in time. Already, the conversation is shifting. We're not talking anymore about just bringing power to the data center. We're actually talking about building the data centers at the power source. Now, that's going to be enormously profitable for the utility sector. So maybe in some ways, it's not surprised that it's a leader. You can see quarter to date, the very defensive nature of the market. Dividend sectors like utilities and REITs leading. Bringing up the rear is growth. And so it was a very, very defensive quarter, really, until right now, because I would have thought something would have happened differently today. And you're going to see from these following charts what I'm talking about. Now, counterintuitive to thinking is the following chart that I'm going to show. I've always thought that when interest rates were cut, the best performing market cap would be small caps. I know I've seen enough research in that regard. I've seen some strategists on CNBC and other stations calling for massive moves in small caps. I'm not crazy about small caps this time around for the following reason. A lot of zombie companies, a lot of companies on life support in that index, held up with government funding, a lot of government programs. I prefer mid caps. And I prefer them because, one, they're proven companies. They were small caps at one time, but they've proven their business model works. They're generally profitable. And in some ways, it's really the farm system for the S&P 500. These are where the next S&P 500 names are going to come from, is some company in that S&P 400. Right? So I like that. Interestingly, yesterday morning, I actually found a piece of research that supports that, and it was a Bloomberg article, and it pointed to some work that Goldman had done showing that in the first 3 months and the first 12 months following a Fed cut, the initial Fed cut, it's mid-caps that are the leading market cap. I found that surprising. It's actually small caps bringing up the rear. Now, I'm going to have to do some more research on this. But that was kind of confirming for me today. And I thought today that's exactly what we would see. Mid-caps would come out of the doors screaming. I mean, I saw in the futures this morning when I got up that futures were going to be up very, very strong. I didn't know the day was going to end strong, but I knew at least at the start that it was going to be a very positive day. So why shouldn't mid-caps lead? Well, it didn't happen. As a matter of fact, I think we got just the opposite of what most people were expecting. The sector, or rather the secular theme laggard in the last 3 months has to be the Magnificent Seven. After being such strong performers last year and the first part of this year, and you know the names. I'm talking about Apple, Microsoft, Alphabet, Meta, Amazon, Tesla. These stocks scream today. As a matter of fact, the Magnificent Seven outperformed by such a wide margin that the spread between that performance and the worst performing market cap, large cap value, was close to 300 basis points. That's 3 full percentage points. That's massive. I think that was a surprise. Now, I try to come up with an answer for it. Maybe this is the shift back to secular growth. If you think about it, if the Fed fund rate comes down, the risk-free rate is coming down, and that does wonders for multiples, valuations. Maybe that's part of the answer. Or it's as simple as maybe this is where hedge funds are living in terms of their short book. Maybe they're short a lot of these names. So maybe this is just a 1 or 2 day move. We'll have to see. I don't think we're going to know the answer to that for a number of days. But in any event, they killed it today. I'm going to pause for a second because I am seeing this story come across my screen. It's a little bit off the beaten path in terms of what we're talking about. But I'm just seeing that J&J is it's actually a flashing headline. J&J is lifting the amount of money that they're putting aside for a settlement on their baby powder. Looks like $8.2 billion. I'm not quite sure how important that is, but it looks like J&J is down in the aftermarket slightly. I'm going to pivot for a second. At this point, I want to pivot to the bond market because I think this is where we're going to get a lot of information about both the economy and the health of this market in the months going forward. Now, right now, what you're looking at there is Fed fund futures. And at least for now, the market is expecting a rate cut at virtually every meeting between now and all the way until the beginning of 2026. That's a lot of Fed meetings. Now, that's a long way away, and these are predictions, not necessarily going to happen. A lot could happen between now and then. Maybe the most important thing that could happen, what if inflation rears its ugly head again? We have a spike in oil or a spike in energy for whatever reason. Maybe it's war. Whatever it is, if you saw that spike in inflation, the Fed would have to stop in their tracks, might even have to reverse course and hike rates. We don't know that. But for now, the market is clearly pricing in a lot of cuts. I think we're pricing in as much as 75 to 100 basis point cuts for the rest of 2024. So that's what Fed fund futures are saying. What is the rest of the bond market saying? Well, what you're looking at right here is the spread between 10-year yields and 2-year yields. Why is that important? It's a really strong indicator of the yield curve, which has been inverted for quite a long time. An inverted yield curve is often thought of as recessionary. Actually, very often the recession doesn't happen until the yield curve actually turns around and goes positive, which it's doing right now. It's actually gone positive. It's not a lot, maybe 13, 14 basis points. But for the first time in quite some time, 10-year yields are now above 2-year yields. Now, it begs the question, what do we do as portfolio managers with that information, especially in our bond portfolios? Because remember, we're not always invested in nothing but stocks. A lot of 60-40 money out there, a lot of portfolio managers, a lot of models running money that are 60% equity, 40% bonds. Bonds are the ballast. That's the safety valve. Kind of protects us when things go bad. A lot of money can be made by investing on that long end of the curve, things like TLT, which is 20-year treasuries. So the question is that still a good trade? Because it's certainly made a lot of money so far this year. Well, I'm going to suggest something different. What if over the next number of months, this yield curve is steepening, but in a different fashion? Right now, the perception is that 2-year yields are going to come down faster than the 10-year yields will come down. So you'll make money on every part of the curve, no matter what. But what if it's this way? What if 2-year yields come down, but 10-year yields, in fact, go up? What would drive that? All right? Well, think about it. We're running debt and deficits so large. We're running a deficit so large that we're now approaching the levels of our defense budget. We're going to have to attract a lot of money as a country, as a government. We're trying to fund our government. And the only way we can do that is to sell paper, to sell bonds. We've got to have buyers for that. We've already had a couple of auctions that were problematic at best. What are we going to do to attract those buyers? Well, it might be that the government's going to have to offer a little bit higher yield on some of those longer dated securities, or we're not going to get buyers for it. Now, we've been very comfortable parking our risk-off capital in the short end of the curve at 5%. That was really attractive, but that's coming down to probably 3.5% for starters. All right. It's not going to be all that attractive. So a lot of people are looking to lock in a rate of return for a period of time and maybe make a lot of money from those yields coming down. You make a ton of money buying a bond that's, say, at 3.7%, goes down to 3%, you're going to make a lot of money in that bond. But what if it's just the opposite? What if it goes from 3.7 to 4.5? That's a scenario that I'm laying out, all right? And a time for caution there. So I'm thinking at this point in time, that trade may be over, making money on the long end of the curve. It may be that we're going to have to live a lot lower in our maturity structure, maybe laddering a bond portfolio from 1 out to 5 years, or maybe 1 out to 6 or 7 years at best, right? That's in fact where I think we're going to have to go. I'm not comfortable at this point in time putting a lot of capital in 20-year paper. As a matter of fact, I think I have some 20-year paper right now that I'm about to rotate into a different maturity structure. But that's my thinking, how it's developing right now. Obviously, we've had a lot of information in these last couple of days. We still have tomorrow to end off the week. We'll see if we get any reversal of this very positive sentiment, very positive price action that we had today. And of course, then we got the weekend. So I got a lot of work in front of me. I am going to be writing about this over the weekend. And of course, I'll be using a lot of the charts that you're seeing right here that will go there. You'll be able to find that article on my Substack site, dcnelson123 at substack.com. A lot of information there. A lot of my podcast inserts go in there. I publish on both the podcast, you'll find it on YouTube, and now you're going to find it on Substack as well. And of course, on Substack, I publish my network appearances. I'm usually on once or twice a week. Anyway, thanks for joining. I'm David Nelson, and this is The Money Runner.